All right, what is up, traders? What's up, tycoons? Super excited for today's video. We are going to break down TLT in today's video. All right, we can see very clearly on a monthly time frame, we've completed a 5-wave structure to the downside, it appears. And the big question is where it can go next, right? So we'll zoom into a daily time frame to look at those possible scenarios. We'll also take a look at Microsoft here, that monthly cup and handle just absolutely exploding. The stock is making new all-time highs. We'll break down Microsoft, and we'll also talk about the S&P 500 SPY ETF. All right, breaking out from that inverse bump and run pattern, looking very, very beautiful. Okay, we're going to break down all of those charts in today's video. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. If you're new to the channel, I started a completely free newsletter for you guys, Investment Intelligence. You need to sign up for this, okay? It's giving out free, valuable finance content, free trade ideas every single week. All right, these are what the trade ideas will look like, highlighting the conditions, showing the chart. And, these trade ideas work out very, very nicely. Okay, I try to, pick high quality setups, high quality trade ideas. This was one on Stanley Black & Decker, highlighting the rising wedge, indicating where price could come down to. And you can see that trade played out very, very nicely. Most of the trade ideas are really golden nuggets. All right, a lot of these trades have worked out very well on the newsletter. So if you're fans of free trade ideas and free valuable finance content, you're really going to enjoy that. Okay, so sign up for that using the link in the description. Huge Black Friday sale going on right now. You guys can join the Investment Intelligence Discord for just $1. Okay, now the sale will be going on until Monday. I just started the Discord very recently. Okay, and you can get in and get your first month for only $1, right? And this is where you'll get access to all of the different analysis, all of the different trade ideas, and all of the different resources that I have available for you guys in the Discord. So, trying to do something special for you guys. $1 is nothing. Okay, there's no reason really not to join. And then if you don't like it after a month, okay, you can unsubscribe to it, and you can leave, right? But I really think you'll enjoy the community. There's people in the Discord making 5 figures, 6 figures on a lot of these different trade ideas and different plays. So you'll enjoy it a lot. All right, now let's start getting into the video. And in the last video, we talked about the market melt up, right? And I gave you guys a bunch of data, a bunch of statistics to really support this market melt up theory. And we're seeing it happen right in front of us, right? Especially since the time of the last recording in the last video. What are the factors really driving this market melt up? Okay, rather than just coming out here and telling you guys and being one of those YouTubers, hey, stocks are going to go up and buy it all, right? And they don't really have anything behind that. I'm going to show you guys some of the data that we've been using, all right, to support the melt up theory. Now, one of the biggest things has been corporate buybacks, right? If you look at corporate buybacks as a percentage of market cap, it's above the seasonal trend for the first time since May. And this week's inflow is the largest in our data history. So corporations are buying up their own stocks, right? And they're doing it at an above average, above trend rate. Okay. And we're seeing very, very large inflows just within the last week. So not only do you have retail traders, institutions potentially buying, but we know for a fact that corporations have been buying back their own stocks. Now, hedge fund positioning in mega cap tech is now back at record highs. We talked about this one in the last video. Everyone talks about the Magnificent Seven. It says it's only 7 stocks driving the market up. Well, if that's the case, hedge funds are betting on that, right? And they're positioned in those Magnificent Seven stocks. And if those Magnificent Seven stocks continue to rise, the market should follow along with them. And that's where a lot of the positioning is right now. Now, there's a lot of crowding, right? So when you take a look at this, hedge fund crowding is now the most extreme it has been in the 22 years that Goldman has tracked hedge fund positioning. What does this mean? It means that all the hedge funds are piling into these Magnificent Seven stocks, right? We see where their exposure is. It's into mega cap tech stocks, right? And we're seeing that it's now the most crowded. That trade is the most crowded trade it's ever been. So while that may be a little bit of a sign that, hey, maybe things are a little bit too bullish and maybe too many people are investing into the mega cap stocks, this is one of the things that's been driving up the melt up theory and reinforcing that melt up theory. right? Another thing is seasonality, right? This is November pre-election year seasonality. There's different election year cycles, right? We're in that pre-election year cycle. The dotted lines are the ones you want to pay attention to. And look at the end of November. The end of November is very, very strong via that pre-election seasonality, okay? Take a look at this, right? We have the S&P 500 performance before and after daily winning streaks. Once those daily winning streaks end, and then this is since 1950. If you don't remember, the S&P 500 just went on, I can't remember if it was 7, 8, or 9 consecutive green days in a row. We'll look at the SPY chart in a second later in the video, and we'll get to the exact number. But when the S&P has rallied from 7 to 9 days consecutively in a row, look at the melt up that happens proceeding afterwards, right? 60 days after that period, stocks are up very nicely. Now, is it as extreme as the rally heading into those? No, not necessarily, right? It's more of a gradual melt up to the upside rather than a face ripping rally that just continues to go higher. This is QQQ here, okay? Look at how closely QQQ is tracking towards the 1999 year. Now, everyone may be saying, oh, well, you're showing 1999. All right, 1999 is going to be this green line here. Well, we all know in 2000, the dot-com bubble happened. Well, we're in the midst of a new bubble that's been forming, and I've been saying this for almost the entire year. The AI bubble is just forming right now. That doesn't mean that the bubble is about to pop. Of course, these bubbles could pop any day, but the definition of a bubble is just investors piling into things because they don't know how to truly evaluate something, right? Nobody knows what the true value AI is going to bring in the future. And so what people are doing is they're piling in and, buying anything they can related to AI to get, because they don't want to miss out on that AI hype train, right? On the AI wave. And so if this continues, right, and if that type of investor sentiment kind of continues where it's like, hey, well, we can't miss out on these stocks. We can't miss out on these AI stocks. We have to buy them up. We have to get NVIDIA. Who cares if NVIDIA went up hundreds of percent this year? I don't want to miss out if NVIDIA goes up more and if AI completely takes over the world, right? So if we look at this is 1999, and look at how this is November here and then December. Look at how the last 2 months of the year in 1999 were. Now, I'm not saying this has to happen, but this would be really, really, interesting. Okay, if you take a look at the correlation between the current year and 1999, it's very, very similar, and we've already started this aggressive uptrend here earlier into November. We'll see if we can potentially follow the 1999 performance and what that can mean for the stock market today. Now, what are some of the things that's really driving this whole melt up theory, right? Well, if you take a look right now, we're looking at the cumulative returns from July 1981 through September 2023 of Vanguard's Federal Money Market Fund, the Bloomberg US Aggregate Bond Index, and then the S&P 500. Why am I showing this to you? Well, because people were getting 5% on money market funds, right? And people are getting 5% on cash. It's very possible that we could have hit a peak in interest rates, or we're near the peak in interest rates. So people are starting to look and say, hey, well, what really can my money do for me right now, right? And do I really want to just farm and yield farm, 5% interest rates, or could my money actually be put to better work, right? And where are those areas? Well, if you look, even in bonds and money market funds, even though they have nice returns, if you take a look, the S&P 500 over the long run vastly outperforms. So even though that interest rates are very attractive and yields are very attractive, people are still saying, hey, well, the S&P 500 overall, gives out better cumulative returns. So I need to take some of that money out of these money market funds and take some of this money out of my bonds and put it back to work in the stock market. Right here, we have a table basically showing you guys the New York Stock Exchange returns when 90% of them have an up day. What does this mean? Well, it means that 90% of stocks in the New York Stock Exchange were green. That's what we experienced on the last CPI print. And if you take a look, 30 days out, the average return is 3%. 65 days out, the average return is 5.35%. Now, we were talking about this in the Discord when the stock market was only up 0.75% after that initial CPI print, where over 90% of all stocks in the stock market were green. and saying how, this could put the SPY ETF at around 462 within the next 30 days, right? And so that means that sometime in December, it's very possible, if not before, that the stock market is going to be around that 462 level, just based on historical data, right? And it's not biased, okay? It's just data, and that's what the data is that historically we're up at least 3% up from that day would put us right around that 462 level, right? So be very cautious, right? If the market runs up a little bit too much and goes up to that 465, 466 beforehand, it's very possible that it drops back down, so that it ends up correlating to that average 30-day return, all right, which is about 3%. But again, that's just a statistic, right? Past performance doesn't guarantee anything in the future, and it's very possible that it can underperform or outperform based on that 3% average. What we're looking at here is going to be CTA positioning. All right. So these are basically algorithms. These things chase and follow the trends, right? So, they're not really predicting anything at the moment. All right. Or really ever, and saying, oh, this is a market bottom, now we're going to go long, or this is a market top, now we're going to go short. They simply just chase the trend, right? And it's very, calculated. And we can see here that the CTA positioning is at extremely high levels that we haven't seen since 2014. Okay. And basically just indicating that, wow, this rally that we have has been really strong. Okay. And CTAs are just positioning and really helping drive fuel, into the melt up theory, right? And we're seeing CTAs following along with that whole melt up theory with the very large positioning that they have. If you, even in crypto, right? If you take a look at weekly crypto asset flows, this is from Coinbase, or I'm sorry, coin shares, but digital asset investment products have now seen 8 consecutive weeks of inflows. However, year-to-date inflows of 3.2 billion remain well below the 2021 and 2020 levels. So, we're seeing massive amounts of money flowing into crypto, right? And we're seeing, again, that 8 consecutive weeks. But, at the end of the day, when you compare it to 2020 and 2021, it's basically half or a third of those levels, right? So, a lot of sentiment is starting to go bullish and more positive back into crypto. It's just not at the same levels that we saw in the past. And it's very hard to tell if we're going to ever get back to some of those levels in the past, right? And there's been so much with FTX, now even Binance, many other exchanges have blown up. Terra Luna, their stablecoin blew up. There's so much has happened, right? That the overall shift in tone has changed a lot in the crypto atmosphere. And, a lot of things have been exposed as scams. And so, during that period where essentially it was free money and free scams going on, and you didn't have to worry about anything, people weren't being prosecuted, nothing was happening to them. We're not in that environment anymore. And so what we're looking at here is going to be flows, okay? And this is into the QQQ. And so what I want you guys to see here is that we have seen the largest amount of flows into QQQ. Basically what this means is that money is pouring into the QQQ ETF. People are buying this up. It's positive inflows. I mean, it's the biggest we've seen and I don't know how long. I mean, it's much larger than COVID, right? It's much larger than 2020, than what we saw in 2020. People are just buying up tech right now, and it's part of that whole AI bubble thing, right? And it's part of that whole, like, is it possible that we could get that 1999 QQQ performance year? It's part of the whole melt up theory, right? And we're just looking at all of this data, all telling us the same thing, that like the market has just been melting up right now, and we're in the process of that melt up theory, but it's not happening to everyone, right? Okay, good old AMC was actually making new all-time lows. Very, very brutal. Okay, I know there's lots of apes out there. I even had a guy tell me, like, man, I haven't seen this AMC stock this low in a while. I think I'm gonna buy some. I don't think he knew that it was making all-time lows. But good luck to him. All right. Hopefully there's a good trade opportunity, but it looks like meme stocks will not be on the menu this Thanksgiving when it comes to eating, right? And eating in the form of, are you eating out here, bro? You making any gains, or what you eating on? It doesn't seem like people are really eating on AMC at the moment. Best of luck to the AMC investors, but that's something that I've never really been a fan of myself. Now, when you look at the Fed cycle script, a composite of the average Fed cycle would cause the following ordering slash timing of events. March equals the first cut. This is an 8-month pause. June equals the recession starts, and then October equals the market bottom. February 2025 equals the earnings bottom. So, the chart may seem a little bit complex, but that's what basically I just explained it all for you guys right there, and it's really, really interesting. The reason I find it so interesting is for a couple reasons, but if you look at the Fed rate, tool, right? They're basically keep pricing in rate cuts sooner and sooner and sooner now. And so based on a historic composite here, it's basically showing that, maybe they're right, right? And maybe we actually may get rate cuts in the beginning of 2024. And then a recession begins. Okay, and it's very typical for a recession to begin after we start getting rate cuts, right? The Fed doesn't really start cutting rates until there's something broken and until there's something really wrong with the economy, right? So it would make a lot of sense for us to get a recession. And so I just want people to keep that in mind, right? I mean, if you're thinking about 2024 and saying, "Oh, well, I'm going to buy here because I think 2024 is going to be a great year for stocks because of rate cuts," you need to ask yourself, well, why would the Fed cut rates, right? And it's probably because we're about to have a recession or in a recession. And so you do want to keep that in mind, right? I mean, not every recession results in stocks going red, but often case that is the time that you would see stocks start to decline. So, what's happening now is future Fed rate cuts are being priced into the market. And so the market's rallying because of that, right? And they're saying, hey, well, it doesn't look like we're getting any more rate hikes, right? They've basically completely priced out rate hikes and priced in the Fed pause for, I believe, the next 2 meetings. And they keep bumping up when the Fed is going to cut rates, right? And it keeps moving closer and closer and closer. And so the market's pricing that in right now. You have to remember the market is forward looking. So by the time the Fed actually starts to cut rates, what's it going to be doing? Well, it's going to be reacting to what potentially is going to be happening in the future, right? Because they've already priced in the potential for Fed rate cuts ahead of those Fed rate cuts. And now if the Fed starts cutting rates, they're going to say, oh, well, maybe it's time for some things to be reevaluated and potentially go lower because now we could be in the midst of a recession. And that's when you would see potentially a decline in stocks. Now, earnings typically tend to bottom um, before, before. So, we'll see how that ends up playing. When in terms of the market bottom and the whole earnings bottom and things like that. Or I'm sorry, rather stocks tend to bottom before earnings. So that's why you see this right here in front. But it's going to be pretty interesting to see how things play out. Now, when you look at Powell's policy sprint and an evolving pause, basically the latest FOMC minutes show all members agreed to proceed carefully on rates. This is basically a solid chart right here from Reuters, summarizing the Fed's policy shifts over the last 30 years. And you can see in March of 2020, we're prepared to use our full range of tools to help keep the economy strong, right? And so in red, we have the PCE annual inflation rate, we have the Fed policy interest rate, and then we have the Fed inflation target. So the Fed inflation target is right there at that 2%, right, for inflation. And we're prepared to use our full range of tools to help keep the economy strong. So they cut rates, right? We have that zero interest rate policy time, that ZIRP time right here. And then as these transitory supply effects abate, inflation is expected to drop. We see PCE inflation continuing to rise, even though they're saying they think it's going to drop. Inflation has surprised again to the upside. All right, that's over here. All right. And then in July of 2023, we will do what it takes to get inflation down as it's coming down. You can see that the Fed fund rate has just continued to rise throughout that time and remain elevated. And so now November 2023, we can proceed carefully, right? And so you can see, basically the Fed policy rate is flat. All right, we're seeing PCE, kind of flattish here. We did have an uptick, in the last couple PCE and CPI reports, right? But overall, we can see that we're in a downtrend, starting to stabilize a little bit here, and hopefully they can get it back down closer to that Fed inflation target. A lot of that is what the market is pricing in. If you look at a sentiment indicator, equity positioning has returned to stretch territory. Okay, meaning that, again, if you're looking to buy here to hold into 2024, right? Not only are things stretched out right now, but we just talked about that possibility of a recession maybe happening in 2024. So, these are things that you want to consider, right? I mean, there's a big difference between trading something and then looking to long-term invest in something. And, when you take a lot of things into consideration, it really does seem likely that we will end up getting a recession into 2024. That doesn't mean stocks can't go up in the meantime, but that means that you guys do need to think about things and think about your time horizon, think about your investments, right? Don't just buy into stuff blindly because you hear that a melt up is happening and you think that if you buy into the melt up, you're going to get these, really big returns or really big gains. You want to, try to buy things at a valuation at a price that you think is fair, that you don't mind holding, even if it goes lower than the price that you get into at when it comes to investing, right? Now, this is TLT. This is our daily time frame for TLT. And the main thing that I want to show you guys right here is a possible scenario that I think, we have a little bit of candlesticks over here, a little bit of structure. We're back up towards those levels. If you see, we rejected the $91.03 level right here and ended up going back a little bit lower. Into my eyes, it would make a lot of sense if TLT ends up pulling back a little bit here. Now, it doesn't have to. These blue boxes right here, these are what's known as gaps, right? And there's tons of gaps on the TLT chart, but we're very close to a gap up here, right up to that $93 level. And we're very close to another gap right up here to the $96 level. So TLT, if it wants to, can continue heading higher and climbing towards these gaps. Now, this blue line right here is the 200-day moving average. And this is basically a little bit of a projection. So no matter what the stock does, this 200-day moving average is going to be gravitating lower. And, if we do end up filling this gap up here to the $96 area, the 200-day moving average is also going to be right around that area. So, that's going to be a really key point. And oftentimes institutions look at the 200-day moving average to determine whether they are long or short something. If something is below the 200-day moving average, oftentimes they'll be short. If it's above the 200-day moving average, oftentimes they'll be long. So the big question, if we do come up to that 96 area, is will we reject the 200-day moving average and come back down, or will we be able to reclaim it as support and start trading above there? Okay, so that's a little bit more of the bullish scenario. A bearish scenario would be, hey, we are at that 91 resistance. We start to pull back here. We've got some critical areas of support that we'll go over. But look at the nice cup that's forming right now. Even if we were to get a pullback, okay, and potentially even fill the gap down on TLT right around $85, which may seem dramatic from where it's at right now, but even that would still be a healthy pullback and align with the Fibonacci retracements to potentially continue going higher. And so what I want to see if we pull back to some of these support levels is, will we be able to pull back, consolidate, and basically put in a handle here, right? And again, we have that cup and handle. If that plays out and we break over the 91 area for that cup and handle and the chart goes something like this, again, $96, $95 is going to be a pretty key area with that 200-day moving average, right? It's going to come down and it's going to be a key psychological level. And then you also have those gaps up to fill. So, things look pretty good in TLT, in my opinion. And, we'll see how things play out. To me, it's a good opportunity if things do pull back, especially from a trading standpoint, a risk to reward standpoint. Let's say we were perhaps in fact to get the gap fill, right? So let's say you put in an entry here just above $95. And let's say you put a stop loss below the recent lows, below $83. Okay. And then you look to target, the $96 gap up, or potentially even this $93 gap up right here. that's a very nice risk to reward ratio where you're risking about $3 to potentially make, 8 or potentially make, 10, $11. So, it's a very good risk to reward setup from that standpoint on TLT if we were to get that pullback. And that's something that I'll definitely be monitoring and paying attention to myself. Again, this is that monthly time frame. So you can, get an idea when it says 5 right here, why this thing says 5. Well, we had a nice 5-wave structure to the downside, and the market tends to move in 3-wave and 5-wave structures, right? So, your wave 5s are your more impulsive waves, right? And leading the trend, right? So you have the 1, 2, 3, 4, 5, obviously very impulsive multi-year, bear market right there in TLT. And then your 3-wave moves tend to be corrections, right? And those will come in the form of an A, B, C. And so potentially, if we've completed this, 5-wave structure to the downside, we would be looking for something like this, an A, B, C here, that would take us over the 200-day moving average, potentially on TLT back up to the 120 to, 135 region. Of course, obviously, this is a monthly time frame, so it'll take a lot longer for that to happen. But, wouldn't really surprise me if that's what we end up seeing, and seeing TLT, go back and after completing this 5-wave structure, getting a nice ABC correction to the upside, and an extended rally, right? This is Microsoft right here. Okay, so Microsoft had a very clean cup and handle. Again, this is something potentially we'll be looking at on TLT for it to happen. Now, this is a monthly time frame, but you can see we put in that nice cup. All right, we came down. We had a few red candlesticks here, and Microsoft is absolutely just broken out, breaking out above 350, its previous highs, and doing a really good job of, getting that cup and handle breakout. And I think in the long run, overall, Microsoft has the potential to head up to 433.83. That may seem pretty dramatic, but I mean, when you just do some simple TA on the monthly chart, even if it was the pullback or something like this still seems like a reasonable target area to the upside for me. Again, it's going to take a longer for that to play out because this is a monthly time frame. But I can definitely see Microsoft getting up there. Now we'll continue moving forward. We'll talk about SPY real quick. I've mentioned before in multiple videos, my favorite chart pattern of the year of 2023 has been the bump and run. And in this case, we have an inverse bump and run. To basically summarize it for you, you have a prevailing downtrend, and then you get this dramatic bump down in the price, right? And so this is your bump right here. And the run is when you break this trend line here. The way that the pattern works is exactly how this worked right here, where you just basically get this aggressive move to the upside, and this is your run, right? So you have the prevailing downtrend, then the bump, and then here we got the run. And in a perfect world scenario, it's going to take you up to where the pattern began, in this overhead supply zone here. And you can see we did that, right? Pulled back a little bit and just absolutely blew through it because you know why? We're melting up, we're melting up, we're melting up. So ultimately, I do think it's possible that the SPY ETF, the S&P 500, can make new all-time highs. We have a wave 3 target up here, and then we got, wave 4 to the downside. This is why it says bearish below right here, 411. And you can see we just barely dipped below there at this level. We did start actually going long on the SPY around this area in the Discord. Okay, and then a huge, tremendous rally afterwards. And things are making a lot of sense, right? And they may not make sense to everybody, but you might just be paying attention to the wrong things, or you might not have an open mind enough, to some of the different scenarios possible. Now, what we need to be mindful of, okay, with that, and speaking of that, is that there's 1, 2, 3 gaps down to fill on the SPY. Okay, this recent rally has been pretty much a straight line to the upside. And it's very possible that, things got ahead of themselves, and, we could actually come down and try to fill some of these gaps, right? We have gaps down to, 426, 425, got gap down here to 446, right? Gap down here to 433. It's very possible that we could end up seeing a lot of these gaps fill if the market reverses, and the market can reverse and basically flip on a dime, flip on a coin at any given point it wants to. So, don't try to chase things necessarily, okay? But, look for really good setups and opportunities, right? I mean, here if we were to pull back into this previous supply zone, you can put on a really good risk to reward ratio trade, where you enter in, around the bottom of the zone. Maybe you have a stop loss just below, right around 448. And if it breaks below your stop loss, most likely it's going to come down and fill the gap. That's a higher probability scenario. And then, you can target some of the highs above, some of the previous highs that we've made, above that supply zone around 456 or potentially even 460. Whatever it is you want. Remember, that data that we looked at did say that SPY should come up to about 462. So that'll be very interesting in my opinion. I want to see if it's possible if we actually get up to 462. That's something I'll be looking at to monitor relative to that data analysis that we showed you guys earlier. Don't forget to sign up for the newsletter, okay? Investment Intelligence, giving out free trade ideas every single week. If you want those straight to your inbox, sign up for the newsletter. And then don't forget about the Discord, okay? It's only $1 right now. Promo code is Black Friday, okay? Black Friday will get you in the Discord for just $1, all right? And you'll be able to get access to all the different analysis and all the different trade ideas.